Hey everybody, this is Hunter Satterfield, one of the partners here at Cain Watters, as well as the Chief Investment Officer. As always, I am joined today by my fellow partner, Brian Bortz, the head of our investment committee here at Cain Watters, and then also Brad Sanders, the Managing Director of Tectonic Advisors, who advises our investment committee as well. This is your November market update. The month of November, which we'll get a little bit more into, is quite interesting. These numbers are not necessarily indicative of what happened in the month. Before the month, the S&P was up 0.3%, global stocks are up 0.1%, domestic bonds were up 0.6%, and then global bonds were up 0.2%. Now, a couple interesting other statistics before we get to questions for Brad and Brian. The equal weight S&P was actually up 1.9%. So again, the 0.3 is the market cap weighted, so quite a big difference there, which Brad will get to explaining here in just a second. And then S&P 600, which would represent small cap stocks, the 600 smallest companies in the public markets, was up 2.7, so significantly more than the S&P. So, Brad, I want to come to you because in the month of November, we started out at a high on the S&P of about 6850, drew down 3% over the matter of a few days, then back up 3.5%, then swung back down 4.5%, and then back up 5%. And so, as we saw in the numbers, ended up basically flat for the month. But that was absolutely not the story sort of intra-month. And it speaks a little bit to the volatility that the three of us have been talking about all year. So, I want to give maybe a little bit of color commentary on kind of what caused those swings in the month, yet the market remains sort of flat for the month.
Yeah, really it all kind of hinged on a couple of things. The Fed came out in early November and kind of threw cold water on the idea that a Fed cut in December is like 100%. And the market has priced in that Fed cut. So the Powell came out and said, you know, our data is not good right now, and kind of left some wiggle room, like we might not do anything in December. The market didn't like that. Then we were having a bunch of earnings from the Mag 7, and it kind of all hinged on NVIDIA's earnings, which were about 2 weeks ago. And in between that whole time of the market swinging around, we were noticing that the rotation we've been talking about on this video for months now that we're kind of positioned for was starting to happen. Healthcare, interestingly, as a percentage of the S&P, hit a dot-com low. That means that healthcare stocks as a weighting in the S&P are as low as they were back in like 1999. And right as they did that, they rebounded. And since like August 8th, healthcare as a sector is up 24% or so. And so we were noticing like these defensive, typically value kind of sectors were starting to outperform intraday. But it wasn't necessarily showing up in the cap-weighted index because you still had NVIDIA and all these stocks going up prior to earnings. And then when NVIDIA came out, they smashed their earnings, but the stock's dramatically lower since then. And once that happened, we saw small caps and basically the broader market start to go up. And while the S&P did, as Hunter mentioned, rally that 5%, it was all due to mostly the broader stuff, the non-tech sectors, which are finally starting to get a bid. And you couple that with crypto, which I believe started the month well north of $100 for one Bitcoin. And it's in the low 90s today. It got as low as like 83,000. Something sick in that market, and that had been basically levered beta to the NASDAQ forever, which I've said many times. Basically meaning if you own the NASDAQ, you own Bitcoin, you can expect to earn 1.2, 1.3 times in Bitcoin. That correlation is completely broken now. You still have the NASDAQ up here, Bitcoin's going like this. And so either one or two things are going to happen. Bitcoin's going to catch up and the correlation's going to hold, or we're probably going to see further rotation with the NASDAQ kind of evening out and the rest of the market lifting up to catch it, which we're positioned for. So it was a great month for us, even though the headline numbers looked like it was just kind of real a benign month. There's actually a lot going on.
Overall, good month for just value-oriented things. And Brian, I come over to you because when we see months like that and swings like that, a lot of times we get stuff from clients. It's like, hey, are we about to have some sort of significant drawdown? And again, you look intra-month, we're down maybe 5%, which is not necessarily uncommon. So I'd love for you to address maybe a little bit of that, as well as address as we head toward the end of the year here and potentially another Fed meeting, sort of what spot the Fed finds themselves as we head into this final meeting at the end of the year.
Yeah, you know, The one thing to keep in mind too, we also just came off the longest tenured government shutdown that we've ever had in the history of our country as well. That had a significant interruption. That being said, the Fed's looking at where are we with inflation, and inflation's at 3% still. And world according to Brian, I believe that 3% is a really healthy long-term inflation number. The Fed doesn't see it that way. The Fed's target is 2%. And if this thing remains sticky and a problem higher than what their target is, they're not going to want to cut rates. I think that Powell has shown a propensity to not want to cut rates when he doesn't have to. And so I agree with Brad, it's not a foregone conclusion, even though the market's priced it in, that it's going to happen. If I were a betting man, I would bet that the market's probably going to cut.
Yeah, Tectonic thinks a quarter point for sure.
I think so too. But you mentioned there's this 5% swing. If you look at where the S&P was at its peak to where it was kind of at one point in November, it had come down 5.7% in less than a month. And the frequency of that happening, if you look at the S&P 500 going all the way back to 1928, so we're talking about almost 100 years. You go all the way back almost 100 years, the S&P comes down 5% on average 3 to 4 times a year. So this is not an infrequent thing that happens, but it's also not a sky is falling thing. And so really what we need to see is exactly what Brad said a moment ago. We need more market breadth. We need small caps, we need mid caps, we need value, we need something other than 7 specific tech stocks to show strength in the market, to add this breadth, and then we're going to have a really good 26 in my opinion. So.
Yeah, one other thing to piggyback on that, one of the reasons Powell is reticent is when they shut down the government, the Fed has a dual mandate, inflation and employment. The Bureau of Labor Statistics is a government institution. It was shut down too. So the Fed didn't get data for a month.
Right.
And they're not collecting data because they're all at home. And so there's this gap between where the data was a couple months ago and what they're getting now. And so they're real reticent to just say we're definitely doing it because they're flying a little bit blind right now. So that's a good point.
Yeah, all good stuff. And obviously, Brian, to your point, as we head into 26, we've got to think more just where the economy is going. And the macro does point toward a very healthy and strong economy. And so we've got a lot of good things to come, despite maybe these temporary drawbacks that might occur because of economic sentiment or whatever else it is. So as always, folks, we'll be back in front of you with maybe a little bit longer one at the end of December with a full recap of the entire year. Otherwise, hope you have a wonderful and happy holiday season.